Hi, my name's Libby Newman and I'm an investment strategist here at Vanguard. Welcome to the Markets and Economic Update. This month, we get a sneak peek at Vanguard's full-year economic and market outlook, which is our biggest annual economic paper, which will be out late December. This year's theme is Beyond the Landing. There has been a lot of market focus on soft landing versus hard landing, yet this emphasis on landing may not fully explain what we have witnessed in the US. The US is within touching distance of its 2% inflation target, a feat that has been achieved without any discernible impact of restrictive interest rates on growth or employment, unlike Australia where we've seen pretty weak growth but still strong employment. In our 2025 outlook, we adopt a framework centred on supply-side forces that had shaped the US economy. Continued US robustness may actually owe more to fortuitous supply-side factors, including higher productivity growth and a surge in the available labour. Higher output and lower inflation can generally coexist only when the supply-side forces are in the driver's seat. Whilst these positive supply-side drivers of growth may continue in 2025, emerging policy risks such as the implementation of trade tariffs and strict immigration policies may offset the gains. Under such a scenario, US real GDP would cool from its present rate of around 3% closer to 2%. These offsetting policy risks may also increase inflationary pressures. Therefore, we anticipate that core inflation will remain above 2.5%, probably for most of 2025. So although we expect the Fed to reduce its policy rate to 4%, we think that cuts beyond that may prove difficult, as any weakening of growth would have to be weighed against a potential inflation revival. Although central banks are now easing monetary policy, we maintain our view that policy rates will probably settle at higher levels than they did in the 2010s. This environment sets the foundation for solid cash and fixed income returns over the next decade. Bonds are still back, but the equity market view is a bit more cautious. The investment challenge is a growing point of tension in risk assets between momentum and overvaluation. Assets with the strongest fundamentals have the most stretched relative valuations and vice versa. The economic and policy risks for 2025 will help determine whether momentum or valuations dominate the investment returns in the coming year. US equities have generally delivered strong returns in recent years, and 2024 was no exception, with both earnings growth and PE ratios, price earnings ratios, exceeding expectations. The key question for investors is what happens next? In our view, US valuations are elevated, but not as stretched as traditional metrics imply. Despite higher interest rates, many large corporations have insulated themselves from tighter monetary policy by locking in low financing costs well ahead of time. More importantly, the market has been increasingly concentrated towards those growth-orientated sectors, such as tech, that support high valuations. Nevertheless, the likelihood that we are in the midst of a valuation-supporting productivity boom akin to the mid-1990s must be balanced with the possibility that the current environment may be more similar to 1999, where a negative economic development could expose the vulnerability of current stock market valuations. Ultimately, high starting valuations will be a drag for long-term returns, but history shows that absent economic or earnings growth shock, US equity market returns can continue to defy the valuation gravity in the near term. Click on the link to find out more about it and to read on.